Welcome to our channel today. We're diving into the world of investing. Whether you're a seasoned investor or just starting out, avoiding common pitfalls is essential for success. In this video, we'll explore the 10 most prevalent investing mistakes and provide you with practical tips on how to steer clear of them. Today, we will talk about the 10 most common investing mistakes and how to avoid them. So before we get started, make sure to hit the like button, also subscribe to my channel. Even if you're already a stock market maestro, understanding where investors often get it wrong can help you become a better investor. Here is a list of 10 popular investing mistakes. 1. Investing without a plan. Having an investing plan or strategy is arguably the first thing you should consider before you invest. That's because your investing plan is personal to you and will help you decide what to invest in and how you invest. Whatever your goals, it's vital you understand what motivates you to invest. If you don't, you could be at risk of committing an investing crime, such as investing outside of your tolerance for risk or hastily selling your investments after a stock market crash. It may be an overused cliche, but when it comes to investing, failing to plan is planning to fail. 2. Trying to time the market. While we'd all like to buy low and sell high, investing, sadly, often isn't as straightforward as this. Timing the market is notoriously difficult, as it essentially requires you to know exactly when a share has reached its peak. While some investors have confidence in their ability to predict future share price movements, data tells us luck is often the biggest factor. As a result, rather than trying to time the market, it may be better to prioritize time the market instead. You can achieve this by holding a long-term mindset. 3. Being driven by emotions. Making investment decisions based on feelings or emotions can lead to unfortunate outcomes. Despite this, it's one of the most common investing mistakes. We're human after all. Avoiding emotion when investing can also reduce the risk of chasing losses or irrationally loading up on shares just because they've recently fallen. Remember, while it may go against your intuition, a share that has recently fallen is just as likely to continue falling as it is to bounce back. 4. Failing to diversify. One of the most challenging decisions a company can confront is whether to diversify. The rewards and risks can be extraordinary. Success stories abound. Think of General Electric, Disney, and 3M, but so do stories of such infamous and costly failures as Quaker Oats' entry into and exit from the fruit juice business with Snapple, and RCA's forays into computers, carpets, and rental cars. What makes diversification such an unpredictable, high-stakes game? First, companies usually face the decision in an atmosphere not conducive to thoughtful deliberation. For example, an attractive company comes into play, and a competitor is interested in buying it. Or the board of directors strongly urges expanding into new markets. Suddenly, senior managers must synthesize mountains of data, including internal rate of return calculations, market forecasts, and competitive assessments under intense time pressure. To complicate matters, diversification as a corporate strategy goes in and out of vogue on a regular basis. In other words, there is little conventional wisdom to guide managers as they consider a move that could greatly increase shareholder value or seriously damage it. But diversification doesn't need to be quite such a roll of the dice. Yes, it always will involve uncertainty. All major business decisions do. And indeed, there is a wealth of good advice about how to approach diversification. But my research suggests that if managers consider the following 6 questions, they can push their thinking still further to reduce the gamble of diversification. Answering the questions will not lead to an easy go, no-go decision, but the exercise can help managers assess the likelihood of success. 5. Focusing on short-term gains. We all like the idea of making a quick buck. Yet, while it can be rewarding to see a sharp rise in the value of your portfolio overnight, focusing solely on short-term gains may tempt you into making ill-advised decisions, such as buying highly volatile stocks. 6. Chasing fads. Under such circumstances, it can be difficult to avoid the temptation to jump on the bandwagon. After all, the fear of missing out, FOMO, is human nature. However, while there are exceptions, many stocks or industries tipped to go to the moon often fail to do so. In fact, investors who find themselves being persuaded by hype are usually too late to the game to make any meaningful profits. Potentially worse than this, investors who chase fads may even find themselves at the wrong end of the greater fool theory by buying into a craze that has already passed its peak. Rather than chase the latest fad, investors will often find more success by doing their own research and sticking to what they know. 7. Not paying attention to fees. High investing fees can be a big burden if you choose the wrong provider. Yet, sadly, there are investors who fail to pay enough attention to fees. As a rule of thumb, it's always worth comparing a handful of investment providers before opening an account. That way, you have a higher chance of finding a provider that charges fees that work best with your investing style. For example, investors who trade regularly will usually be better off opting for a provider with low or zero share dealing fees. In contrast, investors who passively invest in the stock market may be better off prioritizing the cost of platform fees. 8. Being influenced by past performance. Another common mistake made by investors is to be influenced by past performance. For example, if a share price has risen substantially over the past 5 or 6 months or so, it may be easy to conclude that this pattern will continue. On a similar note, if a stock known for its temperamental share price has just plummeted in value, then some investors may believe it's worth buying the stock while it's low. However, making investment decisions based on past performance is unwise. Instead, it's best to recognize the concept of hindsight bias and do your best to ignore it. 9. Failing to review your portfolio. While many investors hold a well-diversified portfolio, it's arguably just as important to review your investments every so often to ensure they continue to align with your investing strategy. For example, say your portfolio consists of 70% equities and 30% bonds. Over time, it's possible your equity allocation rises or falls more than your bond allocation. As a result, if you don't review or rebalance your portfolio, you may end up holding investments outside of your risk profile. 10. Not doing your research. If you're interested in investing, it can be tempting to dive straight in before you really know what you're doing. With the explosion of mobile investing apps in recent years, it's probable there are investors out there who have chosen to invest without doing enough research. To avoid this common mistake, it's really important that you do your own research before you enter the choppy waters of the stock market. If you're a beginner investor, you may wish to read our Ultimate Investing Guide for Beginners. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.